All right, guys, good morning. Let's get the briefing done here. We've had the German data there, and this is the kind of feature of the morning. If I just actually just show you the data calendar just to begin with. We'll talk about yesterday in a second, but we're just kind of in the middle of this data flow on manufacturing and services PMI. So these are the preliminary numbers for January. We'll get final full readings at the start of February for January. And so first real data of the year, first data measuring activity in 2016 for the Eurozone. Of course, most data that we get in January is backwards looking at December or even further back. So, these PMIs here, these soft data releases, first kind of signals as to how conditions are faring in the new year. And with these German figures, they've slightly disappointed. Let's look at the manufacturing chart. This is what, let me just refresh it actually. And here we go. We've got this little, this drop to 52.1. We had expected 53, but it's coming at 52.1. And as you can see, that's kind of, I guess bottom of the range. Well, if you look at the last 12 months, it's been choppy. We've had some bad figures, like the February and the May readings were notably bad, down around 51. But otherwise, it's been, mainly decent with some odd figures printing up towards and above 53, which have been solid. But so disappointment here on the manufacturing PMI number. The services number also missed expectation, but only marginally. If I refresh this chart, you'll get an update bar for January, and so that's dropped off from that top we had there back in December, but this stays pretty solid at 55.4. We had expected 55.5. So overall, these numbers are worse than expected. One sort of bright spot in this very dark start to 2016, one kind of positive thought has been that, well, at least the Eurozone finished 2015 nice and strongly in terms of trend. Look at this chart, this services PMI chart. Look at the uptrend into the end of last year. This has been cause for optimism, and that most analysts around the world are of the opinion that Europe is going to outperform this year in terms of their growth rate improving in 2016, improving on 2015. Whereas if you're looking at the US, most analysts think the opposite, growth rate's going to slip. And the PMIs have been one signal, one measure that's helped to get these analysts arriving at this conclusion. So it's a bit disappointing here that we've seen particularly the manufacturing number just drop off a little bit. So, that's not going to help with sentiment. Now, at the same time as this data was released, we also got comments. Let me take that chart away. We got comments from Weidmann. So let's maybe now talk about, and let me just show you a 5-minute chart, because looks to be a potential trade on here, because look, the DAX is testing the opening low. We got a gap here, a gap down to this high point that we had around about 5 p.m. last night. So that's a 40-point gap. Now, the worse than expected German data has brought us back down to these lows. R1's been good support. We also had Weidmann comments that aren't helping here. So Weidmann being the Uberhawk at the ECB, and we'll talk about Draghi in a second, but Weidmann's just said that ECB's he said the line between the ECB's fiscal and monetary policy is becoming blurred, and this is a cause for concern. What Weidmann, it's almost like he says to Draghi, extending QE over my dead body. He does not want, he didn't want QE in the first place. In fact, he dissented against it. So he doesn't want more. He didn't want any in the first place. So this is a very typical hawkish comment, which may undermine what Draghi said yesterday. So let's maybe just switch and talk about Draghi then, because a couple of big things yesterday was Mario Draghi, and the other one was crude oil. So I guess for once, China wasn't on the agenda as a topic that was dominating global markets. But with regards to Mario Draghi, well, then we weren't expecting anything. That's the thing. Ultimately, we had thought that we were going to get a fairly uneventful ECB press conference. And actually, in the end, that's not what we got. We got a very eventful one. Not that it was particularly straightforward from a trading point of view, but let's maybe bring the euro dollar into play here. Let's increase the size of my chart. I'm going to go to a 5-minute chart. We'll just zoom back on yesterday's price action around the press conference, and just talk through what he said and why we got the reactions that we did. So sharp sell-off here in euro dollar as the euro weakened, as Mario Draghi made what the market thought certainly initially was more dovish comments. What the market initially thought was, here's Draghi again promising to deliver more at the next meeting. So what he said, he highlighted that ECB officials will review and possibly reconsider its policy stance at the next meeting. He made reference to the fact that while the measures we decided in December were entirely appropriate at that time, since then these circumstances have changed. And he then said, we are not surrendering in front of these global factors, pointing towards oil and China. And he said that we are adapting our instruments to the changing conditions. And he said that the credibility of the ECB would be harmed if we weren't ready to revise the monetary policy stance. And he said that the power and the willingness and the determination to act is there, and the fact he pointed towards the fact that there are no limits to our action. Okay, so when you read out those little snippets there, those little extracts from his comments, if you just if you cherry pick the dovish ones and put them all together in one paragraph, it sounds very, very, very dovish. It sounds like he again is promising the world. He did this back in October. He promised to deliver more at the December meeting, and then he spectacularly under-delivered by the time we got to December. He's at risk of doing the same thing here. But certainly initially the market reacted dovishly. You got euro weakness, you got equities up through the roof, you got bond markets rallying. Certainly a very dovish response. But as then time went by, that dovishness, that initial dovish reaction got unwound. Check this out, at a pop higher here at 630, which took us actually back to where we started. And for the euro, it took a hell of a lot longer to retrace the initial moves. For equities, it was a lot quicker. I just zoom back on the DAX here. You got that initial pop higher, and then actually the DAX reversed the whole lot. It only took half an hour to get back to where we started. Then we sold off. I mean, in the end, we had a decent push higher into the European close, but by the time we finished the session, we finished at 9,575 for the DAX, and that was certainly below the initial dovish rally. Now, of course, we popped higher this morning at the open, but I'll talk about that in a second. I think ultimately two things about Draghi. There's precedent now. He disappointed us. His credibility has got damaged after he promised to deliver in October and failed to deliver what he promised in December. Now, are we just getting a repeat? Here he is promising to deliver again, and isn't he just going to fail? Because given Weidmann's comment there, he's got a pretty large barrier to get over if he wants to extend this QE program. So that's one thing. Our confidence in him has been undermined. And the other thing is, well, actually, was what he said entirely dovish? Because I just put together those extracts in one paragraph, and it sounds like it's very dovish. I think the one word in there was possibly. I mean, all he said was, look, at the next meeting, we will review our monetary policy, and we will possibly change it. Now, that's what they do at every meeting. So, that's their job at these 6 weekly meetings, to review policy and possibly change it if it's warranted. So I'm not quite sure whether that is quite the promise that we got back in October. And certainly that's how markets reacted. Initially, it was dovish. We kind of wanted, I think there was a subconscious, desperate need for some kind of relief, some kind of signal that the central banks got our back, in a very negative sentiment market environment. So we'll see. We'll obviously have to wait 6 weeks. It's actually 7 weeks until their next meeting. So, of course, I do think that, as usual, any ECB comments between now and then are potentially sensitive. And, we're still playing this game of will the ECB do more or will they not? And this game will not go away, and it will continue to influence. My ECB comments remain, very influential. The other thing yesterday then was crude oil. I mean, before I talk about crude oil, ultimately, will Draghi do more or not? He can't say, and he didn't say yesterday. The only thing that will determine whether he does more or not is entirely based on the fundamental economic data between now and the next meeting. That's it. All right, if we get more carnage in markets, let's say we get another 10% sell-off in global equities by the time we get to March, well then fine, maybe he's going to have to do something to calm the waters. If we get a significant downturn in Eurozone economic data, well then fine, he's going to have to do more. But if those two things don't happen, then he won't do more. So ultimately they are data dependent. Right, here's oil. Significant day yesterday. Well, every day seems to be significant. But for once a powerful move higher, and we've added to it overnight, back above $30 here. Now, the rally here off the inventory data at 4 p.m. Let's talk about this, because ultimately, when the data hit the news wires initially, on the face of it, the news was, in theory, negative for price. Let me remind you here. Here's the headline feed from 4 p.m. yesterday. So what we had was a crude oil inventory number that showed an increase in inventories of almost 4 million barrels. That's a larger increase than was expected. We had expected an increase of 2.2 million. That in itself, in theory, that's negative for price, more supply than expected. Okay. The Cushing number, well, actually, there's not too much difference here, but that increased by 191,000. We expected 400,000. So actually, if anything, that's positive for price. Less of an increase than expected. Gasoline, big increase, bigger than expected, 4.5 million barrels. We had expected 1.9 million. Distillates went the other way. This is positive for price. Less supply, a drop of 1 million barrels when we had expected 800,000. The overall output production increased. Again, it's just phenomenal, the resilience of this shale industry. But oil output went up by 0.087%, up to 9.235 million barrels a day. That's negative for price as well. All you do is look at these numbers, well, then they're mixed as usual, but you would say negative for price. But hang on a minute. Oil rallied hard. And it's never as straightforward as just looking at these numbers and pulling the trigger. There's many other factors to consider. Firstly, what were the API numbers the night before? Well, the API indicated an increase in crude oil of 4.5 million barrels. So actually, this number below 4 million was lower than the API implied the night before. Okay, so from that point of view, you could say that's positive for price. The other thing to think about here is on the gasoline side. Let me just bring something up here. So gasoline inventories went up again, and actually there's more gasoline stock in the US than there has been since 1990. Now the thing about the kind of data yesterday, it actually did show that gasoline demand increased to 9.1 million barrels a day, which actually put it at a 600,000 barrel increase from last week. This is gasoline demand. This is petrol. How much petrol is being bought? Gasoline futures hit a 7-year low yesterday before the data at basically $1. And then it rallied hard off the back of the fact that gasoline demand has jumped sharply, 600,000 barrels more than the week before. So actually you've got gasoline rallying hard off the back of that information, which I think certainly contributed to the fact that oil moved up. Is this the low for petrol prices? We've actually seen a real pickup in demand because it's so cheap. Is this actually a signal that maybe we're beginning to see that economic stimulus come through from the fact that energy is so cheap, and maybe consumers are going to start to spend some of this money they've been saving? But from a gasoline point of view, that stat is quite interesting. I think certainly helped to turn the corner here. The other thing is, don't forget, I know this is, in many ways, this oil move was counterintuitive. If I just go to a daily chart, well then, I don't know, we're below 30 bucks, right? It's the first inventory data we've had for 14 years. It's the first inventory data where the price has been below 30 bucks, okay? Saudi Arabia said yesterday, for what it's worth, price below 30 bucks is irrational, okay? One of the biggest oil producers in the world said that. Below 30 bucks, inventory data, I would actually hazard a guess that it didn't really matter what the numbers were yesterday. I think that people used it as an excuse to book profit. I mean, maybe that's ultimately the biggest driving force here. A profit-taking opportunity, information flow that in theory is negative for price, brings in some sell-side volume, but people who are short use that sell-side liquidity to offload their large short positions and book profit from what's been a phenomenal trade. So maybe it's profit-taking. Maybe it is that first signal that there's a turn here. When you get data that should send the market lower, but in the end it sends it sharply higher, well, that's a pretty interesting and potentially powerful sign that there's exhaustion on the downside. Coupled with that kind of stat on gasoline demand going sharply higher, may well, and what's happened overnight, we've added to that. Back to the 1 hour chart here, we're importantly back above 30 bucks. That level from earlier in the week at 31.36 is important. That was the high back on Tuesday. And so for now, we've got a real powerful rebound. And that's a $10 10% rally, by the way. 10% rally in basically 12 hours. But we're still at $31, so we're still right at the bottom of this just phenomenal move. So keep your eye on oil. Certainly oil's helping with stocks here this morning. We had a real positive move across the Asian space. Lots of big upside on Asian markets. The Bund, just keep your eye on the Bund here. We've just ticked down through some technical support. This is the Wednesday's high, 161.31. We're just down through that. The DAX bounced off that opening low. We did not get a move into the gap, and we've found support and we've lifted back higher. The S&P is looking to try and work its way up through yesterday's high, which is also R1. Euro stocks just up at the high now as well. Let me just check in with this euro move, which I still think the euro dollar is a hard trade. After yesterday's chaos, we're really in the middle of yesterday's range at the moment. I guess from a resistance point of view, the pivot level and Tuesday's low is a good price point to have a look at. We haven't been up there yet, though. That's 108.74. That's a key resistance. So, let's see then, what have we got for the rest of the day? We've got some UK data. Let me just bring up that data calendar again to kind of finish off with here. UK data at 9:30. Retail sales figures, trade balance data. With retail sales, we're expecting negative prints on the month, so minus 0.3%. Let me just show you, we had a nice positive reading for November up at plus 1.7. You can see this is fairly cyclical into, we typically get positive, negative, and this pattern is certainly expected to continue. We're expecting a negative print here. The most important thing about this chart is, by and large, the positive months are quite significantly bigger than the negative months. So overall, you've got a positive annual trend. Okay, so we are expecting negative news here, but bear in mind we had a powerful print for November. data's at 9:30. In the afternoon, we've got data out of the US, quite a bit of data. We've got the PMI numbers, the manufacturing PMI number. We've got existing home sales, and then we've got leading indicators. And earnings-wise, a bit quieter today, but we've got General Electric. They'll be the biggest earnings report. We do have Draghi in Davos. Okay, so after the ECB meeting has been done, it's completed, and so they all get into their chauffeur-driven limos and potter on up to the Alps and participate in the world's richest conference. So Draghi's talking today, but he's already spoken. He's not going to say anything new. We've got Nowotny later. We've got Core. We've got lots of ECB chat. We've got Cunliffe out of the Bank of England at 12. But really, there's not much more these guys can add after the event from yesterday. We've got Forbes as well from the Bank of England talking, so keep your eye on these monetary policy speakers. But for now, we've got a bit of a relief bounce on oil, but that price point, the higher the week at 31.36 is key. With regards to risk assets, like equities, we continue the bounce. This has been, for the S&P, we bottomed out Wednesday afternoon at that phenomenal drop to 1800. And here we are 80 points higher with 1900 in sight. Let me just finish. This is the last day of the week, obviously. Let me go to the weekly chart. If the S&P can post an up week, that would be a pretty powerful signal. Given where we were on Wednesday afternoon, making a 2-year low, testing 1800. If we can close this week positively, that would be a pretty impressive effort from the bulls, and may well, be enough to just put in place a floor for now in what's been just a carnage of a 2016. So be aware of that. The opening price for the week in all these markets, but here the S&P, the opening price was 1870. We can finish above there and anywhere near 1900, and then that's a phenomenal result. If you'd have asked somebody Wednesday afternoon as we were flirting with 1800, what's the chances of seeing us bounce to 1900 by weekend? You'd have been laughed at, and yet actually it's a genuine prospect. So let's see how we get on. For now, we are still hanging on to this positive sort of rebound mindset. Oil's going to play a role in that. If oil can make new highs for the week, it's certainly going to help with that equity move higher. All right, enjoy the session.